Joining me now is Paul Hickey, Bespoke Co-Founder. Paul, what should we make of this?
Well, if you're having a good August, you've had a miserable decade. I guess that's what you could say, John. But we've been, more broadly speaking, just the laggards, whether you look at year to date, during the month of July or over the last 10 years, like you just cited, those stocks have seen some increased attention in August, and they've outperformed. And that kind of rotation is healthy to see in the market. It indicates, like you said, a broadening of the rally. And you can't just have the same names going up and up and up nonstop. You have to have, some changing of the guard, so to speak, over time. And I think last Friday, what we saw in the rally following Jackson Hole's speech by Powell was an incredibly strong breadth rating in the Russell 2000, one of the strongest single-day breadth ratings in the last 15 years. And those historically have been very positive for forward returns going forward in the small cap space.
Yeah, but that worries me a little, Paul, in that, I mean, if there's some bargain bin rating happening here, people just maybe buying some stuff that hasn't performed too well because it's cheap on hopes that it'll do better. I mean, might that be a reason why this small cap rally won't last?
Well, no, I think as far as the small caps, when you see such a broad rally there, I think that's just a sign that, what we saw with Powell is we didn't see a big move higher in long-term rates. So when the Fed cut rates last fall, we saw long-term rates go up, which was very negative for small caps. People expecting that to happen again this time. The Fed hasn't cut rates yet, but just the signal of rate cuts didn't push the long end of the curve higher. And I think that's something we can take encouragement from. And even today, when you had the controversy over the way Trump announced the firing of Cook, the long end of the curve really didn't respond much. So I think in that respect, that's a positive signal for the market. And what you see is the home builders have been doing really well. And that suggests more hopes that rates will stay contained, which would be great for the broader market and not just the mega caps.
What about NVIDIA as a sign for the overall market? I mean, whatever their results are, clearly people have big expectations for NVIDIA because of how well it's performed up to this point. Even on strong earnings and strong guidance, sometimes the stock goes up initially, sometimes it goes down. How should investors interpret the way those results are received, however good they happen to be?
Yeah, so we talked about this last quarter when they reported. NVIDIA had a record of reporting these great results and selling off on the news. Last quarter's earnings report, the stock, performed well and kept going from there. And that was a sign that investors, that year-long consolidation period was over. Now we're up 40% since that last earnings report. So expectations, like you said, are high. I think if you see a subdued reaction to NVIDIA, that would be more positive for the broadening out rally. Whereas if we get NVIDIA do, rally and then continue going from there, it's going to suck some of the oxygen out of the room for the rest of these stocks.
So it's positive for the broadening out rally if the reaction is subdued, not negative for everybody.
Right, I think so. I think you could say that. You don't want to see NVIDIA have poor results and fall sharply, but a subdued reaction. We have high expectations. The trend this earnings season is for stocks to not necessarily react real positive, even to strong results. So I think in NVIDIA's case, it would just be a continuation of that trend.